latest data as released at this point in time shows that the government sees FY26 GDP, that's GDP for this financial year 2026, at 7.4% versus the estimate of 7.5%. So there's a bit of a drop there, but we'll have to see what our experts have to say. We'll soon have our experts joining us as well into this conversation to help us understand the first layers of these numbers. But the big point here is the fact that we have the GDP numbers that have come in. We also have, as I was saying, Gaura Sen Gupta, Chief Economist at IDFC First Bank, and Radhika Rao, Senior Economist, Executive Director at DBS Bank. Thank you so much, ladies, for joining us in this conversation. Let me start with Gaura. Gaura, are these numbers to the tune of what you expected, and what does this mean for the budget?
So you'll have to tell me the nominal GDP. So real GDP has come at 7.4% for FY26. For us, our expectation is higher. We see definite upside risk. We are at a 7.6% in real growth rate terms. If you look at high frequency indicators, there is a broad-based pickup of growth in Q3 for both urban, rural, thanks to the GST cut. Rural, in fact, had begun to pick up in Q2 itself. We are also seeing quite a pickup in consumption, in production activity. You look at production indicators, freight movement. Also, there's a whole combination of monetary policy stimulus, fiscal support is showing signs, and especially in the Q3, and we expect Q4 also to be on the higher side. As per our estimates, you will also get the transient support of the deflator. The GDP deflator growth will turn negative in Q3 because WPI is negative, so that will further boost real growth rates. So we see upside risk to the 7.4 real GDP growth. For us, it's tracking at 7.6 versus the 7.4. For the union budget, the budget had penciled in an 8% nominal GDP growth. I'm not sure what the advanced estimate nominal GDP growth is, but we see some upside risk there also. Our estimate for nominal GDP growth is tracking at around 8.2 versus the budgeted growth of around 8.
Okay. Notice. So nominal GDP growth was seen at 8% versus 9.8%, and the GDP growth is being seen at 7.4% versus 6.5% on a year-on-year basis. Some other key data points that are kind of emerging at the moment is also the fact that FY26 agriculture sector growth was seen at 3.1% versus 4.6% in FY25. So there's been a bit of a drop on those metrics. I'd like to get in Radhika Rao on this. How do you see this particular drop, Mr. Rao?
Hi, Malika. I think certainly what we were looking for, obviously, the farm sector is very important in terms of where the overall growth grows, and it seems to show around the 3% mark. But if you look at the other breakdown, it's along what was the momentum, I think, in the first 2-3 quarters of the year. Of course, we have official data only for the first 2 quarters of fiscal 26, but the third quarter also, just like Gaura mentioned, is going to see quite a strong upside. In fact, our own estimate for growth is much stronger. It's at about 7.7% for fiscal 26 because it's taking in a strong Q3 and a slightly sub 7% Q4, which, overall average is giving us a quite high number. In terms of the drivers, I think investment and consumption would both be quite important. And I think both of them, at least the breakdown initially available, seems to suggest that that's what MOSPI is also factoring in. And insofar as the nominal GDP is concerned, it seems to be showing at 8%. I think the actual number will be a bit higher than that. But there's still a gap between what the budget number set at 10.1 and what the prevailing nominal GDP seems to suggest. But let me also add here that the pace of nominal GDP is one thing, but if you see the nominal size of the economy, truth be told, fiscal 25 was actually bigger than what was budgeted. So fiscal 26 need not be that much bigger. Even with that about 8.2, I think we will be quite safe in terms of the fiscal deficit numbers. So overall, I think the numbers for first advance estimate are more or less where the markets expected. But I think when the second advance estimate comes out late February, it will be affected by a couple of things. Firstly, of course, it's going to be a rebased data. So we will be talking about completely different set of, breakdown and numbers when we speak again on this. But even apart from that, if you had seen in the past as well, there usually is an upside bias to this first advance estimates, because this captures data from about November, a bit of December numbers, and there is still more, nearly a quarter to go. So routinely seems to usually has an upside bias to the actual or revised numbers.
All right. But you did mention that investment and consumption would be key influencing factors on this number. We have my colleague Shrimi Chaudhary also joining us to help us understand the first cut. Shrimi, what are you gathering from these numbers? What kind of a story do they tell?
Yeah, very clearly, if you see, there are two important headline numbers. One is, of course, the real GDP, which is more or less on the expected line, which is 7.4%. And the nominal GDP, which is 8%, market expected around 8.3 to 8.4%. Now, nominal GDP is, of course, very important, and that's the number to actually watch out for, because that is going to set the tone for government, how they're looking at the revenue, the spending, and overall fiscal deficit. So that's the key number we need to watch out, and that is coming at 8%. Now at 8%, if you compare that with the previous assumption, previous budget assumption for the current financial year, it was 10.1. So is it a kind of risk somewhere on the growth? Clearly no, because with 8% of nominal GDP, it's pretty clear that government is on the is on the track as far as fiscal numbers are concerned. However, there could be some changes you could perhaps see in the revision of the tax numbers, the revenue numbers in the upcoming budget. The another important factor which need to be watched out, that what is government going to have projection for the next financial year in terms of nominal GDP growth, because 8% is giving you that much of cushioning because of the broad base in the FY25, which is around 9.9%. So clearly that sort of cushioning is coming, but definitely the government will take a call on how they're going about their targets, the budgetary targets in terms of the revenue projection, in terms of their expenditure, as well as whether they are able to keep the fiscal deficit target at 4.4%. Is this first estimate which is going to decide? Malika?
Yes. As you mentioned, the fiscal deficit, and in fact, Radhika Rao was also talking about it. Ms. Sengupta, I'll get you in on the fiscal deficit number, because the GDP figures is a very important factor when it comes to managing the fiscal deficit. How do you think, now that the numbers have come out, would the fiscal deficit for FY26 be impacted, and what direction is it going to take?
I just want to give one caveat. So the 10.1% nominal GDP growth that was budgeted, that was based on FY25 RE of GDP. So what happened was FY25 nominal GDP turned out higher than the RE. So if you put the implied budgeted growth rate of nominal GDP on FY25 actuals, the growth rate, budgeted growth rate is actually 8%, not 10.1%. So if the advance estimate is indicating the nominal GDP growth is at 8%, which is on top of FY25 actuals, then it's in line with the union budget. It doesn't add or reduce. From a fiscal perspective, this has been a very challenging year for the center as well as state governments in terms of tax collection. For the center, we see quite a shortfall in tax collection. Our shortfall in gross terms is tracking at around 2.5 to 2.8 trillion in gross terms from the budgeted target. And this is reflecting the substantial income tax cut, the substantial GST cut. On top of that, slowdown in nominal GDP growth from a 9.8 in FY25 to an 8% growth estimate for FY26. As per us, nominal GDP might be slightly better. So we are building it maybe at an 8.2. Versus the advance estimate of an 8%, or the budgeted estimate also of an 8%. So there is a challenge that has happened on the revenue collection front, but we still expect the center to meet the 4.4 target. Reason being, non-tax collections have been very robust. You have an RBI dividend, which is higher than budget estimate. The center is also earning more on excise duty collections because they had hiked petrol diesel tariffs in the month of April. They had hiked the duty on petrol and diesel. The other support is PSU dividends, especially oil PSU, coal PSU dividend. That will be higher than what is budgeted. So, and on the expenditure side, especially revenue expenditure side, we see sources of saving. One is the just-in-time cash management on the funds that the center provides to states for expenditure on schemes. There, every year over the last few years, the center has been saving money because of just-in-time cash management. The other source of savings is that interest cost for the center is tracking lower than the budget estimate. Plus, there are various other areas where certain ministries are tracking lower than the full year budgeted number. And now we are entering Q4, so they cannot spend, the full budgeted amount because there's restrictions that are placed in Q4. So overall, even though the tax collection will be weaker than target, the fiscal deficit is still met at 4.4.
Thanks for that clarity, Gaura. This is Shrimi from Delhi. I wanted to understand that with the nominal GDP coming at 8% for the current financial year, what's your expectation on the next financial year, that is FY27? Because clearly this will going to be the base for government to decide on the nominal GDP for the next financial year. So what's your estimation?
So as Radhika mentioned, we'll be getting the new base GDP. So our estimate is still on the old base, but it shouldn't make too much of a difference. Our estimate for FY27 nominal GDP is tracking at around 8%, is around 10%. So from an 8.8% around FY26, it picks up to 10%. The pickup is led by the deflator growth picking up, because next year you'll have a base effect which will lift both CPI as well as WPI inflation. So we do expect the nominal side to pick up to around 10% in FY27, which should be a little helpful in terms of tax collections. In real terms, we expect real GDP growth next year to be around 7%. It actually could be higher, but for now we are sticking to a 7% for FY27.
Okay. Radhika, I want to come to you just for understanding, because as we all know that from February 27th, when you will have the second advance estimate along with your Q3 numbers, the base year will change. The base year will be now 22-23. So all these numbers, we have seen quarter 1, quarter 2 with 7.8% and 8.2%, and now this first advanced estimates of GDP. All these numbers are set to change anyway. So what's your sort of view on that, where these numbers stand?
Thanks, Shrimi. Certainly, I think for all of us, I think there's going to be a big bunch of changes coming. GDP, inflation numbers are also going to look different. Of course, the base year for inflation will be, will be 24. And then you've got IIP, which perhaps will be released later in the year, April, May, where we're going to see another set of change because of the base year. Now, going with the past revision, I mean, if I were to look at the 2015 revision, of course, it's hard to pen at this point where exactly the number would be. But I would think there would be a slight upside bias rather than a downside bias to the numbers that have been released. In 2015, we also had the GVA series that was introduced. We moved from factor prices to market prices. So quite a bit of methodology changes also that happened back in 2015. And I think there would be more such at this point, because you will have more granular data, you will have more sectoral data that will be introduced as well based on what MOSPI has been telling us in the past few weeks. So putting all these things together, I would say that fiscal deficit for FY26, to our mind, is safe to the extent that we do think that the 4.4% of GDP target will be met. But fiscal 27, the focus is going to change. Your nominal anchor or target for fiscal 27 is going to be debt levels and deficit levels, right? So the finance minister had mentioned in last year's budget that you're not going to be looking at just the deficit point target anymore. It could be a range, and you will be looking at in cohort with where the debt levels are. So from that point of view, I think with a 10% nominal GDP assumption, I think a 4.3 or 4.2% of GDP sounds doable. But I also add here that from here on, I don't think the space of consolidation is going to be very aggressive. I think from pandemic, we're already at less than half. But I don't think in the next 4-5 years, the idea is to pursue very strong fiscal consolidation. I think there is a very clear agenda, at least to our mind, that the government wants to back all its new and strategic priorities, so which means that we want to get a bigger piece of the supply chain pie. We want to focus more on infrastructure outlays. It's already been mentioned about deregulation and decriminalization. So I think the focus is more on supply side and demand side pressures, because truth be told, the global environment is extremely challenging at this point, from the trade front, from policy front, from security apparatus front, all of that, right? So I think the agenda will be to strengthen the domestic economy as much as possible. So on defense, on infrastructure, on support to states, as well as the supply chain bit. These are some of the priorities we think will come out of the budget. So coming back to your question, I think the rebase numbers, if anything, based on past experience at least, could be similar or have a slight upside bias, which essentially again plays back to the fact that the fiscal deficit targets, at least that will be set for fiscal, which have been set for 26 and might be set for 27, we don't expect a big overshoot or undershoot based on the kind of trend growth that we see.
So both of you actually, Radhika and Gaura, you're saying that the fiscal deficit target will be on track, and that is 4.4% for the current financial year. But one thing I wanted to ask, since we have seen the impact of income tax cut on the tax collection, we have reached around 73 trillion so far, and we have 1 quarter left. Do you see some sort of downward revision in the tax collection target for the current fiscal, and government would also sort of decide its next year target based on the nominal GDP?
Sure. Who's this question for?
Gaura, you
This
can answer
question
that.
is for whom? All right. Thanks.
Gaura,
as I mentioned, we've seen, we are seeing quite a significant shortfall in tax collection. For us, gross tax collection is tracking at around 2.5 to around 2.8 trillion lower than the target. And this is spread over income tax as well as the GST collections. Income tax collections there are two reasons for the miss. One is the target of the income tax collection in the budget was very ambitious to begin with. So if you look at the budget growth rate implied of income tax in FY26 based on actuals of FY25, it's a growth rate of almost 22% in a year where you're having a substantial income tax cut. Secondly, because of the nominal GDP growth slowdown, that further adds to the slowdown in income tax. Plus, last year, the income tax got a little bit of support from the equity market performance. That's missing in FY26. So that's another drag. So yes, definitely we expect that the target for tax collection has to be revised down in the RE number for FY26, which will get presented in the union budget. We see a shortfall in both income tax as well as shortfall in GST tax collection for the center.